Hi, everyone. I'm Rick Bensignor, and welcome to this weekly edition of In the Know Trader. If this is the first time you've listened to our video podcast, then I'm here to tell you that our weekly show combines educational aspects about the markets, often going in depth into new models and indicators that are generally used by the institutional Wall Street community, and are often new ones you've never seen before. In fact, the whole reason I started In the Know Trader was to give individual investors access to the how, the when, and the where professional money managers enter and exit the markets. My weekly tactical trader report gives my clients the precise information to give them a far better chance of competing on a fair playing field than they can generally access anywhere else. So in addition to education, I also try to review several important markets, stocks, and ETFs each week to give you my thoughts on where key levels are and where institutions will likely be playing. And by the way, commonly used technical indicators that most individual investors use, like RSI, Bollinger Bands, stochastics, 50 and 100-day moving averages, and the like, are not generally what professionals use to decide where and when to position themselves. I figured I'd tell you that, and again, that's why I created In the Know Trader. And then the third piece of our In the Know Trader shows is to interview key figures on Wall Street in a more relaxed and often longer time spot that we can spend together than you typically see in, let's say, a 3-minute interview on one of the business television networks. So to that point, I am thrilled to have Stephen Schork join us today for a chat. Stephen is the principal advisor of the Schork Report, a commodities market consulting and publishing firm. He is regularly seen on CNBC, Bloomberg, Fox Business, and the like, quoted in all major business media. And he truly is one of the most sought-after experts for the energy complex in the country. So, Stephen, it's an honor and pleasure to have you on our In the Know Trader show. And I've got lots of questions to ask you I'm really excited about. So, first of all, welcome.
Oh, it's great to be here, Rick. I'm looking forward to this.
Well, thanks. So first and foremost, being that you are such a recognized expert in the energy field, I want to ask you something about the oil market, which is kind of near and dear to me, and get a sense from you, what the heck happened in the fourth quarter of last year when WTI oil went from $77 down to $42 a barrel? What was your take on that?
Yeah, absolutely. And I was well published in the media about this, Rick, beginning back in September when the market began to rally. We have to appreciate that oil prices or any commodity price follows a seasonal pattern. It's almost like a sine wave. So you have to ascertain when you're entering or exiting the market, what point of that wave or that curve that you are on. And going through last summer, we were in a very normal pattern. That is to say, we came into the summer, and obviously this is your peak demand season, not only just for gasoline, but for the manufacturing of gasoline. So very bullish for crude oil, very bullish for gasoline. And in fact, last summer, we had never seen demand for gasoline or crude oil as high. It was at record highs. So you had a rally in oil prices, WTI prices on the NYMEX, rallying from about the low to mid 60s to the mid to high 70s at its peak back in July. Very normal. You were getting that price rise at the peak part of the demand season. So very normal pattern there. And by the time we got into the middle of August, we were back down. That is to say, oil prices were back down into that mid $60 to low $60 range. Again, very normal, because once you get into August, you only have, or the middle of August, you only have 2 more weeks before what? the Labor Day holiday. And
Right.
then, of course, we begin to go into the turnaround season, the maintenance season. So refineries cut back their purchases of crude oil in the months of September and October by about 1.5 million barrels a day from the summer peak. So all of a sudden we got into September and we know demand is going to start to fall off hard for crude oil. And of course, we're not driving out to the Jersey Shore or over to the Poconos. So we're not driving as much. So our gasoline consumption goes down. But a really odd thing began to happen in September. Oil prices began to rally. And by the late September, early October, oil prices were back challenging the highs. Actually, they were even higher than we saw during the peak demand season.
Yeah,
So
they
intuitively,
took out that high at 74 and change in the fall.
exactly. And this never made any sense. And then you have to go back and you read the headlines, and people are making excuses. And I always tell people, if prices are rallying, you know why they're rallying? Because there are more buyers than sellers. But we also have to have a reason, or we have to assign a reason. So the reason that was being trumpeted by our friends on Wall Street was the fact that coming 2 months on November 1st, we were going to reinstate the sanctions on the Iranian oil sector. Now, this doesn't make any sense if you buy into the efficient market theory, because we knew about those November 1 sanctions back in April. And back in April, May, June, July, August, those sanctions had no impact on the price of oil. But all of a sudden, we get into a lull in the market. That is to say, we take 1.5 million barrels of fundamental demand out of the market because the refineries aren't buying. We take gasoline demand out of the market. And so Wall Street invents this headline about Iranian sanctions and what this potentially means. And because we're trading futures, people guessed, and they guessed wrong. And so we had this bubble that was inflated through September and October. So come November, the bubble implodes. And as you know, Rick, you and I have been on Wall Street a long time. Whenever a bubble inflates, when that asset price comes crashing down, it not only comes crashing down to where the bubble started, but it always overshoots. Think of a pendulum. We hit that midpoint and we were swinging far to the other side. And that's where we were in December. So you had a rash of scary economic numbers. All markets, equity markets, so forth, were weak. I think that you had the combination of a fundamental, an implosion in a bubble, coupled with fear and greed and weakness in other markets, and that helped us hit those lows back in December. But obviously, we had quickly overshot the value of oil because thus far this quarter, oil prices, of course, have rebounded back to, I would say, where they belong at this point.
So one of the things that I like to think of when I think of bubbles and kind of the market finding an equilibrium price is I often use the analogy of stretching a rubber band to as much as you possibly can. And most people don't realize it. You probably almost have to see it in slow motion film. But if you were to stretch a rubber band, let's say in between your thumb and your forefinger, as much as it could go, and then let go, if you filmed it, you'd actually see that it doesn't just come back to its equilibrium resting place. It actually comes in farther than it in reaction to the maximum stretching before it finds itself at equilibrium, kind of just a rubber band sitting on a table. And it's the same type of thing you're saying. So it sounds like the oil market got stretched way too high to the upside and then collapsed almost further than it should have, just as the offset to the stretched bubble. In one way, it overshot down, got under $50 and went all the way to 42.5. So
Absolutely.
Today we find oil creeping above $57 a barrel, which is, so let's see, from a peak of 77.42, it's not quite halfway back up, but it's close. Where do you think it's headed now, and why?
Well, I do think, Rick, at this point in the late first quarter, the market is seeking out its bottom right now. I do expect the prices to remain, that is to say, linger down in the $50 range through the end of the quarter into the fourth quarter. But we're certainly searching out the bottoms, because Just like in the fall, we're in the spring. So the refinery industry, for those who are not familiar with the oil industry, has two distinct turnaround seasons or maintenance seasons. One in the fall when demand fundamentally is at its weakest, and again at this time of the year, once again when demand is weakest. And this is the opportunity that refiners take to retool, to do maintenance, to acquire the appropriate feedstocks or the blend stocks to make the appropriate quantities of gasoline going into the summer. So we're at the weakest demand part of the season. So hence why I do think that we are where we are supposed to be as far as oil prices go. From this point on, Rick, as we go into the second quarter, and of course, as summer demand ramps up and we begin to purchase more crude oil, and at the same time, we begin to feel the impacts of not only production cuts coming out of Saudi Arabia, but you'll start to see, I believe, cuts coming out of Russia. Now, if we recall back in November, the Saudis and the Russians said they were cutting production, but anyone in the know knew that there was no way that Russia was cutting their production back in November because the bulk of their production is in Siberia. And logistically, it makes no sense to go ahead from an engineering standpoint to go and shut a well in Siberia in the middle of winter. But as we get into the spring thaw in May, you'll start to see those barrels, I believe, held off of the market. So you have the combination of rising demand on the global scale, a pullback in production, but to that extent, U.S. crude oil production is at an all-time high and will only continue to climb higher. So U.S. production, to an extent, will offset some of the loss of barrels from Saudi and from Russia. But be that as it may, there is going to be an inflection point on the supply side, and we do know the demand side is going to continue to move further out along the x-axis. So certainly I would expect to see prices back into that mid to high, maybe even low $70 range at the peak this summer. Rick, I really don't think we can go much higher than that from an economic standpoint, from a demand standpoint, because to your point, this market, gasoline, the inelasticities of demand have completely changed, and no longer can prices go to unforeseen levels without a quick and violent reaction from the demand side of the market. So I do think we're at the bottom at this point, and as demand picks up in the months ahead, prices should pick up, potentially going towards that high $60, low $70 range once again.
So, Stephen, what do you think, for those who are bullish oil over time, which I am personally not, but you're much more the fundamental expert than I am. I'm more in the camp that the $77 high we saw last year is not just a cyclical high, but a secular high. But let me ask you, so what's the best way for, let's say, investors to capture this bullish move? Would it be literally trading, let's say, the ETF that tracks the oil market? Are they better in, the Exxons and Chevrons of the world? What's the best way to capture if oil moves from the mid-50s back to, let's say, mid-60s to low 70s? What's the best way to for the individual investor to capture that?
Sure. I've always been a fan of the infrastructure plays, part of where money from the large trading houses, professional trading houses, the Glencores, Vitols, Trafigurs, and so forth, where they make their money is on the geographical arbs. That is to say that the differential in pricing between a producing area and a consumption area. And so that's where you get your largest disconnects in prices. And of course, these companies are adept enough to act quickly to close those arbs. But those arbs do open up when you do get, say, a cutback, a sanction, as we said, on Venezuelan oil. And all of a sudden, you're Valero, and 90% of your foreign crude oil slate comes from Venezuela, and you can no longer buy that. Well, a company like Valero now just created an absolute arb because of those sanctions. They are stuck buying it. So to my point now is to look for the infrastructure plays, pipeline plays, crude oil tracking plays that are looking at hot spots of where the consumption is and where the production is and what's the link there. And if there's a difficulty in that link, for instance, the amount of oil being produced in West Texas and the inability to get that oil out of West Texas and get it up to either the demand center in Oklahoma, which is the delivery hub for the NYMEX contract, or to the export markets along the Gulf Coast, you're going to continue to see these wide disconnects. And whenever there's a wide disconnect, there's going to have to be a play, either pipelines, rails, trucks, what have you, to go ahead to exploit, to close that arbitrage.
Interesting. All right, let me do this. Let's switch a little bit and bring the geopolitical picture into the discussion.
Yes.
To me, and I suspect a lot of our listeners who are interested in the energy markets, Venezuela is kind of a big mess right now. What's that? Mm-hmm. What's the mess there, the political mess, and how the U.S. is treating the official political leader versus the non-official political leader? What's that going to do to the oil market in 2019?
Right. Well, we've been watching, and I've been writing the short report since 2005, and been writing extensively about Venezuela since 2005, when the Chavistas and their socialist Bolivarian revolution was at its height, when oil prices were at $130, $140. So everything seemed great there. But since 2005, and even really before that, Venezuela has just been a slow train wreck, just an absolute wreck you're watching in slow motion. So I know that Venezuela is now on everyone's radar outside of the oil industry, but this is something, and that's been that declining situation has been well telegraphed for the past 10 years. And certainly after oil prices crashed in 2015, it's really exacerbated the situation there. So what does it mean? Well, first, if you are if you're looking at the situation from U.S. reliance on crude oil, it's really a non-starter now. Because once again, referring back to the efficient market theory, if you are aware of the potential disconnect in supply, then you've had plenty of time to go ahead and move your trading patterns. So the U.S. per se is in a much better position, say, than Venezuela is. But there are a couple of companies. I think Valero, as I mentioned before, I don't know what was happening and what their thought process, Rick, was over the past year, because they have two refineries in the Gulf Coast, one in Texas City and another one in St. Charles, Louisiana. And the Texas City refinery, of all of the heavy sour crude oil that Valero relies on to buy globally, 94% of it comes from Venezuela. In their St. Charles refinery, 98%. So Venezuela, so a company like Valero, Citgo, of course, which is owned by the state oil company, Chevron to an extent, and these are the three large U.S. oil companies that are still overly reliant on Valero. So I'm not certainly keen on those companies, especially a company that has to buy oil that it used to get from Venezuela, but now has to go out and source that oil elsewhere. And what has happened, Rick, is you're starting to see, of course, the type of oil that these refineries buy, those prices are being bid higher. So now their refinery margins are getting squeezed. So for a number of companies, per se, it's a difficult situation. But the majority of the market has had opportunity. The U.S. Has cut its dependence on Venezuelan crude oil by 2/3 over the last 10 years. So those barrels can and are being sourced elsewhere. It is supportive of the market price, but it's not catastrophic for the market price. Interestingly enough, from a geopolitical standpoint, it's actually Venezuela is more dependent on U.S. crude oil, now that the U.S. is now an exporter of crude oil. And by this, I mean condensate. And condensate is a very extremely light crude oil. It's referred to as the champagne of crude oil because it is so light and so easy to refine. And what Venezuela needs that type of crude oil for is because the type of oil that Venezuela produces, it's basically tar. It's mud. It's highly viscous. Can't move it through a pipe. Yeah, it is sludge. So you need to mix it. You need to cut it with a lighter oil, so a very light oil like condensate to help loosen that viscosity so they can actually move the oil along their pipes. Now, of course, Venezuela would never bring itself in this current regime to buy U.S. condensate, but it is forced to go out to buy condensate-like products or naphthas from other allies in West Africa, Angola, or Algeria to cut their oil. But that said, they are more reliant on imported crude oil, so they can even manage to export the feeble amount of oil there already. So right now, from a geopolitical standpoint, certainly this administration is playing hardball. So U.S. companies are backing off, banks are backing off. So I think the time is nigh that we begin to see the end game here in Venezuela. Now, what it transitions into, of course, as we saw in Iraq, all of a sudden we're not going to see a little mini United States pop up down there. So what I can almost guarantee is whether Maduro stays or he leaves, we're going to continue to see chaos and volatility out of that region for the years to come, which would be supportive of a sour or heavy crude oil relative to the lighter crude oils that trade on the NYMEX, WTI, or on the ICE exchange, the Brent contract.
So does that give any type potential spread between, let's say, Brent and WTI, which is already trading at, I don't know, what, a $10 premium, something like that? Would you suspect that stays that way?
Yeah, absolutely. Whenever you have increased geopolitical risk, be it from Venezuela, of course, the situation in China, Russia, production cuts coming out of OPEC, it's going to be more supportive of price for Brent. Brent being, of course, more of a global market. The majority of oil, foreign oil traded around the globe, is indexed against the Brent contract. So whenever you have any sort of geopolitical chaos or uncertainty, it's inherently a greater push on Brent than it is for WTI. And on the other end of that, with WTI, which is linked, of course, with U.S. crude oil production. And as I said before, U.S. crude oil production is going all out. And regardless of price, we have to keep in mind that crude oil production is going to remain here in the United States very strong through at least this year. And this is because last year, last summer, and last fall, as we said, when oil was hitting that mid-$70 range, well, you were able to, and refiners and certainly the clients I was telling to hedge, were hedging a lot of their 2019, 2020 production at very attractive levels. They were hedging their oil at $15, $20 a barrel higher than where we are now. So since they've sold all those future contracts, they're going to have to produce the physical oil to offset those contracts. So U.S. crude oil production is going to remain very strong. So you have the double whammy of geopolitical chaos globally, which is supportive of Brent, and you have record and rising U.S. production, which will keep a damper on WTI prices. So yes, this is certainly supportive of the Brent premium trading over the Brent premium to WTI going through this year.
Interesting. Let me turn to this while we have a few minutes left. What do you think about the future of the renewable space, what we'll call clean energy, in particular, solar, wind, even water? And that's kind of the first part of the question. And the other is, how do you feel about that part of the energy market relative to traditional fossil fuel type companies?
Yeah, I think we'll go back to our high school calculus. We're at that dy over dx moment, where first and foremost things like solar and wind and renewable. I've never have been, never will be a fan of the government ordering my local utility that 15, 20, 25% has to be generated off of this renewable. That's just economic or just complete ignorance of market dynamics. So that does not work because we're just taking, of course, money out of one pocket and transferring it to another pocket. So net, it's a non-starter commercially. But that's not to say that there are certain markets where this does work. Certainly markets in Southern California when it comes to solar. And we've seen an absolute a transformation of the pricing markets for how power is priced, because you have an overabundance, even on your hottest days in Riverside or San Bernardino, you have an excess of power in the market because of so much solar, and so power prices remain depressed during the day, and power prices don't rally until late in the afternoon, early evening, when you lose all that solar generation and you have to start firing up natural gas generators. So it clearly has had an impact in that market successfully. It's having a positive impact in, say, the West Texas market. There are days where you'll get brutal heat in the West Texas or in the Panhandle there, and some of that demand is being offset by wind. But of course, in the heat of the day, it's hot because the wind stops blowing. So the wind, there is the point here being that there is a balance. But going in the future, the genie is out of the bottle. With regard to especially my children, your children, Rick, they're going to have it's a different world. Whether they want to make a socially conscious decision that they don't want to consume a fossil fuel, well, that's a market demand. And if you have that market demand, there will be an entrepreneur that will meet that demand, and you let this grow organically, and it will grow organically. As far as traditional fossil fuels, I think my own personal anecdote here is I'm an oil guy. I've been an oil guy since the first Gulf War in 1990. And I drive an electric hybrid SUV. And I envision my next purchase probably won't be for like another 7 or 8 years, because I just bought this car. I think the technology get to the point and I think it'll be to the point where that might be all electric. Or when we think about driverless technology, or there's a phenomenon now with kids. You know, Rick, when you and I were 16 years old, and anyone listening our age, when we turned 16, first thing we did we went to the DMV and we got our learner's permit, and we were driving by the time we were 16 and a half. Today, with social media, the kids do not have that desire. So there's been a notable drop off with the younger people seeking driver's license, seeking cars. So it's a much different world. So you're not, and I agree with you. I am not bullish long term on the fossil fuel, be it that the demand patterns have changed, and they've changed because of inelasticities. Economics 101, Rick. You need two things to impact the price of a good. You need price shocks. And in the energy industry, going back to the Arab oil embargo in '74, the Iran-Iraq war in the '80s, Saddam Hussein, so forth, we've had plenty of shocks, plenty of spikes, and then plenty of dips in prices. So we've always had that volatility. But up until the last 5 years, we've never had the other variable that changes people's demand patterns, and that's the substitute. And so we have hybrid.
We have something that's coming. That is certainly viable, and getting more economically sensible for people. Stephen, we got about a minute left. I understand that you are providing our listeners with a very special offer. The Shark Report will extend a free trial subscription to your daily report if they go to your website, which we've put up here. It's sharkreport.com, and use the code InTheKnowTrader, and people can sign up today to get a free trial to the Shark Report. So I want to thank you for that. And of course, thank you for being our guest. We got a very terrific, in-depth, detailed look into the energy market today from one of the top experts on the street. So I really appreciate you coming today, Steve.
No, I appreciate being on, Rick. Thank you very much.
Well, thank you. And of course, to contact me, you can send me emails at rick@inthenowtrader.com. And of course, if you want to find out more about when and where professional money managers position themselves in the market, you go to www.inthenowtrader.com and look up more details there. Thanks, everybody, for listening. Thanks again, Stephen, and we'll be back next week. Signing off.